and welcome to yet another edition of Markets and Macros. Every month, our attempt is to kind of step back and, from this daily, day-to-day market chatter and focus on some of the very important macroeconomic forces that are shaping markets, domestic markets, global markets, trying to understand what's at play and trying to see what is its impact on our domestic portfolios. That is the attempt of what we are doing here. And today is 31st of July, and when we did this session the previous month, it was a very different context at that point of time, and in 30 days looks like the global context, the local context, everything has changed. And so that's what we're going to be discussing today. And joining me is Shankarraman, our CIO. So welcome, Shankar. So I'm going to begin with, like I mentioned in the introduction, it's been a big reset in 4 weeks. Last month, when we spoke about this, there was no fear of tariffs. The war was ending, rates were looking okay, and crude prices were probably at 60. 30 days and everything has changed. We are back to having tariffs, we are back to the war, and most importantly, I think the big supporter of growth, which was this whole AI capex, in 30 days, it's come from being the biggest support to growth to now becoming the biggest question mark. So how would you kind of therefore piece all of this together for an Indian investor? I mean, if I were to talk about primarily this whole AI meltdown, how are you viewing it?
Yeah, so I think last 6 months and now, in fact, last few years only, I would say, I think we are all now trained to kind of recognize that the shifting sands of the market is there to stay. I think things are changing so rapidly. So, and therefore, I guess we make it a point to date our videos as well.
Yes,
right?
yes.
So yeah, I think last 1 month, I mean, there had to be an inflection point in this whole build out that was happening, in this whole mega capex, that was happening. Somewhere that had to turn. I mean, it was just a question of time rather than a question of whether that was coming or not. So I think what is important, I think, from what we have seen in the past, is in all such periods when there is a change that is happening in terms of how markets are viewing any such mega theme that is played out, is the pace at which it kind of disinflates.
Okay.
So this whole AI thing, the way the capex is kind of played out, now the normalization process, if one could call that, is it going to be disruptive or is it going to be a gradual process? That is the key thing, rather than the normalization process itself. The fact that the capex was happening, I mean, it is, I think, quite understandable that no capex cycle can continue at that
Forever
breakneck speed for a very long time. I think
Correct.
Somewhere the rate of change will keep diminishing and then it will turn.
Correct.
But the important point is, after it turns, how does it disinflate? That, I think, is the important point that we will need to kind of track closely. I think it's too early to say how things are actually headed in that direction, because the markets are yet grappling with this issue. Because if one company is reporting a higher capex, it seems to be getting punished.
But Google, I think, for instance.
But some other companies saying that they are increasing their capex, they seem to be getting rewarded. So the market is also kind of trying to distill and kind of take a more nuanced view to this. So I think that is something that we'll have to see how this actually pans out. Obviously, the point is whether it's going to be disruptive, whether it's going to be slightly more gradual kind of a process, is what we need to really look at. But looking at the past cycles, And if you recollect the internet boom that happened, 2000, typically, when things inflate very fast, they also tend to disinflate at a fairly fast speed. So therefore, one should kind of be prepared for something, along the way. So I think that's really what it is on that piece.
I'm going to just talk about this for 2 minutes because I wanted to understand. So there are two parts here. One is the actual capex, and the second thing is in terms of how markets are viewing it in terms of valuations.
Yeah.
So where do you think is the problem? Is it more to do with valuations having run up, or probably expectations having run up way ahead, and therefore they are kind of coming back? But the underlying spend seems to be continuing if the number was 1 trillion in the next 4 years, I don't think people are going back on that as of now.
Yeah. So you're right. It's not that there is a deceleration in the capex space as such.
It's expectations, I would imagine.
Yeah, it is just that I think people are slowly realizing that the profitability expectation that was there on this capex, how much of that is getting realized, what is happening to pricing as such in that space. One step, if you go ahead and see, how are companies really benefiting out of this?
You mean the non-AI companies, the users?
The adopters,
yes.
How are they benefiting? Are they willing to pay the price that is required to meet that profitability? And so I think these are natural questions that will have to be answered, and I think that's probably where the market was getting a little nervous. And I think in this case, just like it happens in every other cycle, when such a cycle really plays out, you will see trickle effects of that spreading into other parts of the market as well. Like it is happening in this case where private credit is also getting pulled in that space. You're seeing a lot of financial engineering happening, whether it is the circular revenue part, or the fact that SPVs are getting created. Or the way in which the revenues are getting booked in one set of books and expenses are getting defrayed over several years. So these are all issues which typically start coming through when the market starts getting a little nervous. So I think we are just entering that stage now. So next few months all of this is going to unfold.